What's up, guys? Welcome back to another episode of Behind the Facade. I am your host, Gavin J. Gallagher, and on this podcast, I explore the mental and emotional game often playing out subconsciously both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Guys, real quick, if you're serious about scaling your property investments, then you need to check out my Elite Property Accelerator. Whether you are stuck on raising capital or structuring deals, or indeed just finding the right opportunity, this is the blueprint you need to take your portfolio and your finances to the next level. No fluff, just real world strategies that work. So guys, hit the link below. It says learn more, and I shall see you inside. What's up, guys? Welcome back to another episode. And I think last week was the first time that I introduced what I called a hot take. And I talked about the fact that the RPZs, or the rent pressure zones, were currently being looked at for being abolished. And what's interesting is that straight off the back of that, we have the next day, they're talking now about the potential introduction of tax breaks for both investors and for house building to try to boost it. Now, I'm glad to say that I'm finally back on track. And if everything is going according to plan, you will be listening to this on Monday morning as I'm actually sitting on the beach in Tenerife. Hopefully, fingers crossed, it all goes according to plan. It was pretty big news, the RPZ thing, because it's been around since 2016. And now that the cabinet apparently are now looking at tax breaks, you can see that there's some sort of momentum building towards major change. And I think everyone in the country, and definitely the politicians, they recognize the fact that there is something has to be done about it. It's at breaking point now. And the government, I guess they're pleased that they got into power, and now they got to go and do something with that mandate. Now, there's a whole idea that I have to talk about today. Tax breaks. What are my predictions for the tax breaks? Like, there's not that much information on the ground, but there is a few pointers that I've seen that just suggest what we might expect from tax breaks. I'm going to look back at the tax breaks that we had back in the early 2000s that drove up the big boom that we had. And I'm also going to look at what is likely to be brought in. So my predictions for tax breaks that may be looked at by the government and why those are being introduced. Now, if we go back to the early 1990s, back when I started university, I started university in 1991, and I remember I used to have to walk through Temple Bar back at a time when it was a really, really run-down place. And at the time, like most people who of my age will remember just how run-down parts of Dublin were. I remember I used to park my car over on the south side, and I used to walk underneath the central bank. And then I would walk down towards Crown Alley, and I would cross the Halfpenny Bridge, and I would walk up Liberty Street. Then I'd walk up Henry Street, and I'd walk up Mary Street. I'd walk up towards the back of Bolton Street. And I used to cross, and I used to pass lots and lots of car parks. They were basically future development sites, but at the time they were just covered over in tarmac, or some of them weren't even covered in tarmac. They were just huge, big blocks of land that were just completely leveled, and it was just a car lot. And that's how I remember Dublin. I remember crossing site after site after site that was just flat ground. There was nothing there. When you go down there today, there's 8-story buildings just everywhere you look, and it's quite unrecognizable. But what people don't realize is most of that was done because of tax breaks, because at the time it was hard to start developments unless tax breaks were in place. Now, going back to the example of Temple Bar. I can remember hearing, when I started studying architecture, I can remember hearing that there had been at one stage, maybe in the 60s or 70s, there had been an idea that why don't we just flatten the whole of Temple Bar, and instead of it being this kind of cultural centre that it is now that attracts lots of tourists, it was going to be a huge big bus depot for Dublin Bus. They were going to be able to come to the centre of Dublin and park all of their buses in a 50-acre site or something of that nature. And this is what they were trying to prevent from happening. But how do you kickstart a development when it's hard to find people to buy, it's hard to find people to lend money to, it's hard to find lenders willing to give money for projects unless they make sense at the very, very outset, before you have proof of concept. And so if you don't know that you're going to be able to sell a property at the end of the development, then the lenders are kind of wondering, how is this going to work? Everyone's scratching their heads wondering, is this too great of a risk? You introduce tax breaks, and the tax breaks suddenly de-risk the deal to an amount. And people say, okay, well, at least if I buy this, I can offset a whole load of the purchase price against my taxes. And that's how a lot of this happened. So this is how Temple Bar was built. And it kick-started the industry, and it encouraged the pioneers to venture into otherwise risky or unattractive areas. Like urban renewal was done this way. And it just made the whole thing a little bit more palatable to the people who wanted to develop but didn't want to risk everything in the process. Now, as I said last week, the reaction to the news about the RPZs has been quite predictable, and it's been split down along this classic divide where you have the politicians on one side saying that the government is now kowtowing to the industry and all this, and on the other side, the industry themselves are not that happy with the performance to date. And so there's always, it's hard to keep everyone happy, but something has to be done. However, this is going to be highly offensive to many corners of society. There's already this false narrative, in my opinion, that the landlords are all multimillionaires and that they're squeezing the poor little tenants. And so the thought of developers and house builders making off like bandits with all these tax breaks, that is the perception of a lot of, we'll say, the opposition parties, that this is going to be guys flying helicopters again and driving big, fat, flashy cars and stuff. But I think we have to try something different because it's not working at the moment. Back in 2007, we built 85,000 housing units. Today, we need 96,000 a year, and yet we cannot get even 35,000 built in a single year. So we're about a third off of where we need to be, and we're about half of where we used to be nearly 20 years ago. And in addition to that, the population in that period of time has increased by, I'll explain actually exactly, the level of demand that we have today is massive. Everyone knows that. And yet 18 years ago, we were building 85,000 housing units. Now our population is 800,000 to 1 million people more than it was in 2007. And yet we're only at 50% of the same building capacity. Like, it just makes no sense at all. So I believe tax breaks are definitely a step in the right direction, but they're only a small part of the overall solution. This has to be a joined up approach. You have to be thinking about this across all the different aspects of it. So you've got the tax breaks will make it more attractive financially, but what about the planning system? The planning system is in an utter shambles. The best example of this is the recent news that the Dundrum Shopping Centre, the old Dundrum Shopping Centre, which I know since I was a child because it was quite near to where I grew up, they went in, I think it was Hammerson and Allianz, and they went in for this huge scheme, 900 units. And they started work on this in 2021. They've spent years collaborating with the local authority, collaborating with local groups, professionals involved in all this. I would imagine this scheme has cost at least $1 million, if not more. And it's taken 4 years to pull together a really well-considered scheme. And if you think about where Dundrum is located now, you have the Lewis running right through the middle of it. You also have the Dundrum town centre there. So all of the amenities that you would ever need for a huge, big increase in the density of housing. And yet, with all of these things going for it, and it's also close to the M50 motorway, with all of these things going for it, in the middle of a housing crisis, 900 apartments turned down in the last month or so. And so these guys that own this huge piece of land, that have spent 4 years and who knows how much, but definitely more than $1 million, I would say, they are now back in the exact same place they started in 2021. They have absolutely nothing to show for it. So during a housing crisis, can you imagine anything more ridiculous than that? So something has got to be done. And I think tax breaks, I applaud the government, although it is a little bit late. But at this stage, I applaud the government that they're at least willing to open their mind to something as politically, potentially unpalatable as tax breaks. Now, let's go back and have a look at the tax breaks from 2000, the early 2000s. That's when I remember the boom times. And there was several tax incentives that were aimed at stimulating the property development and investment industry. And these measures significantly influenced the real estate market, and it all led towards the big crash that we had. So you have to be measured in your approach. The key tax incentives that I remember, and there was lots of different names for them, but the one that was really stands out is Section 23 relief. Section 23 allowed investors to deduct the amount that they paid, a portion of the amount. What they would do is there was the construction or the refurb cost that was allowable against the against the income that you would generate from the property over the following 10 years. So let's say you bought a property for 200,000 and let's say it cost 100,000 of construction. Maybe the site had 100,000 of value. You could take that 100,000 and you could apply it against your rental income over the next 10 years. And so it meant that you were reducing the rent that you were, or the tax you were paying on your rents. The next thing was the Rural Renewal Scheme. And this was introduced to promote the development of less populated regions. And it offered tax incentives for residential and commercial properties in specific rural areas. We also had the Urban Renewal Scheme. Now, I was involved in one of these schemes, and we built a car park building right in the middle of very close to the Temple Bar area. And we had double rent relief for a period of 10 years on the rent that we paid. So what we did is we built the building, sold it, and then we rented it back from the purchaser. And whatever we paid in rent, we were entitled to double that in rent relief. And so it meant that whatever the business generated was pretty much tax-free for a period of 10 years. Now, you might say, oh, not fair, but hold on a second. It was an empty lot and it had been sitting there for maybe 20 or 30 years as a derelict site. And then suddenly along comes somebody and develops it. And this is the only way you could make it financeable, because it was not a given that you were going to have a profitable development at the other end. And then the other thing that stimulated a huge amount of transactions in the market was capital gains tax was reduced. From 1997 to 2000, capital gains tax was reduced from 40% down to 20%. And that meant that all of the profits that we were making, we only paid 20% tax on those. So this was good. The mechanisms for some of these things, it was like investors could offset specific construction costs against taxable income, and the lower rate that you paid on the capital gains type, it basically incentivized more frequent transactions, and it incentivized speculation. And that immediately got areas that were not going to be touched starting, let's take a punt on this because there's tax breaks. And that was how it kind of worked. Now, the impact and the uptake of those tax breaks is also very important because it leads you to understand how the likely view of those tax breaks today, looking back. So first of all, there was a surge in construction. From 2000 to 2006, house prices more than doubled, and tax breaks were a key driver of this. Overdevelopment is the next thing that happened. The incentives most definitely are viewed to have contributed to an oversupply of properties. And this was particularly in less populated rural areas. And that led to the emergence of what's known as ghost estates. Those are, little housing estates that were unfinished and just abandoned. And I remember reading that in 2010, there was something like 2,300 of these dotted around the country. And they were basically, houses that maybe there was 20 houses built right up to the roof and everything. But the final, basically they just stopped in their tracks. Somebody hadn't connected up the water or hadn't connected the sewer or hadn't connected the power. And there was some additional payment to be made. And so the whole thing just was ground to a halt. All of this led to overheating in the market and this property bubble. And then obviously the 2008 economic global crash that contributed to all this. And effectively the country was bankrupted by it. But it was bankrupted partly because of the fact that there was runaway lending at the time. The banks were very, very easy to get money from. They were just throwing money out. And so the whole thing was kind of like a vicious cycle, with the banks feeding into the tax breaks, feeding into speculation, feeding into a consumer boom with everyone making lots of profits and not having to pay so much tax. So the whole thing just grew and grew and grew. Hey guys, if you're listening to this and thinking I'd love to invest in property, but I don't even know where to start, well, I've got you covered. I am launching the Property Starter Pack on the 1st of March. It's designed specifically for beginners. There's no jargon. There is no overwhelm. It's just a step-by-step plan to buying your first property, whether that's your home or an investment property. You want to do that with confidence. And here's the kicker. The first 100 people to pre-register are going to get an exclusive early bird discount. And so I've put a link below to register your interest. And so find that in the show notes below and secure your spot. Now, back on with the episode. Now, more recently, the government have introduced various tax measures that have tried to get the thing started again, like to kick off certain things. And for example, to address housing supply and affordability, the rent tax credit increased from 1,000 for individuals and 2,000 for couples in 2025. And so that's at least something. And then the Help to Buy scheme has been extended to the end of 2029, and that is assisting over 50,000 individuals and couples in purchasing their first home. Pre-letting expenses relief has been extended to the end of 2027 to encourage landlords to bring vacant properties back into the rental market. And then also introduced to further boost unused, to boost housing supply and support home ownership. The vacant property refurbishment grant is out there, and that is offering up to 70,000 for the conversion of derelict non-residential properties into homes. And it's just, the idea is bring more housing stock back to the market and revitalize essentially unused spaces. And then we have the first home buyers scheme, and that is where up to 30% of a new home up to 30% of a new home's cost to first-time buyers is being helped by local authorities and things like that. So the whole thing it's just making it more affordable, but there is criticism in some corners that is what is pushing up the price, because if you look at which segment of the market is rising, it's a lot of first-time buyer type homes. Now, the big problem with the 2000s and all those tax breaks that I mentioned is there was this problem that grew from it. And the government is going to be very, very aware of this. And so the market overheating, that is obviously a big issue. They're going to try to avoid any kind of market overheating. And so broad tax incentives that could lead to excess speculation and further inflating property prices. That is something they definitely don't want to happen. Revenue implications. Significant tax breaks could reduce government revenue, and that is something that they don't want as well. And then overdevelopment. They want to be careful that the incentives are done to create surplus housing in the areas that need to be put. They don't want to have these ghost estates appearing again. And so what is my prediction for the tax breaks that are likely to be introduced? Given the history that's gone before it, the government are probably going to be looking at targeted, time-bound incentives rather than broad, open-ended tax breaks that could overheat the market. And so based on the past tax incentives that are there, I think these are the most probable things that we're going to see. Brownfield development tax relief. So this is likely going to come in the form of a Section 23 style tax deduction for developers or investors that are refurbishing vacant or derelict properties. And that's what's known as a brownfield site. You'll be in, like I described at the beginning in Temple Bar, all of these kind of like derelict houses and lots that have just been demolished and it's just a kind of piece of land. Those are quite difficult to do up. There can be quite a heavy construction cost to those, and you would want to go and make them as attractive as possible. And I know certainly one of my clients owns two old properties that are in a derelict condition, and they're listed, and he has been looking at what can he do to develop this property, because when it's listed, it makes it even more expensive. And so this could be exactly the thing that will work for him, because no matter what you spend, maybe it's a very expensive rebuild, but all of that is qualifying expenditure. And so this could actually end up being something that he or the person who buys it from him are able to avail of going into the future. So that could be something that's very attractive. It would encourage regeneration of the city centre, but it would prevent this kind of urban sprawl where the city keeps on going further and further out into the distance. What they could do is it could take the form of accelerated capital allowances, allowing write-offs over shorter periods to make projects more attractive. Now, there's also going to be tax relief. I would imagine they're trying to bring back the big funds. And so tax relief for build-to-rent developments. And given the government's focus on increasing rental supply, a relief for institutional landlords to invest in buy-to-rent schemes could soon be introduced. And what that might look like is a reduced capital gains tax for long-term investment. The way it worked with the buy-to-rent planning in when buy-to-rent schemes were all the rage in the last sort of 4 or 5 years, is that it was a minimum hold of 15 years. If you built this, if you got special, you got special exemptions around the mix of properties and the way it was laid out and stuff like that. But you could not put these on the market. You had to hold them for a minimum of 15 years for that to be within planning. And so that's the kind of thing. But if you're going to hold for 15 years and have reduced capital gains, then that could be quite attractive. There could also be something done around VAT, because VAT is quite an additional expense on new build property. Anytime we build a house, it is 13.5% VAT has to be added to it, and then that's what the purchaser is paying. And so the purchaser pays us for the house, and then we have to take 13.5% and we have to pay it to the taxman. So obviously, if that was reduced, the taxman would not get as much, which they don't want. They don't want to have a reduction in that, but it would mean that you don't have house prices at the level that they're at. Now, the next thing that the government are likely to introduce is a private investor tax incentive. And this is going to be focused on small-scale landlords. And so to attract smaller investors back into the market, there has been everyone's talking about this landlord exodus. And so we have to try to reverse that. And it used to be that people would buy a home, and when they moved to like a different property, instead of selling it, you'd hold on to it and you'd rent it out, and then you'd have a rental property. And nowadays, there's just so much red tape involved with that, and it's taxed so much and stuff. A lot of people weren't doing that, and so the rental supply has collapsed, which has massively increased rents. And so it's an attempt to try to put a halt to that. So what could happen is a reduced tax rate on rental income for long-term landlords. Now, that is definitely, at the moment, if you're renting your property, you deduct your interest on your mortgage, and then everything is at 52% tax. That is substantial. And that is one of the reasons why people look at companies and things like that. But there's also tax on companies and stuff. If it could be reduced tax on rental income, that would make a big difference. Allowable deductions for mortgage interest, maintenance costs, refurbishment, that over and above the current levels, that would be obviously attractive. And then tax incentives for social and affordable house development. And that is something that really, I think what the government is likely to do is introduce corporate tax breaks for developers and REITs that are investing in social and affordable housing projects. At the moment, I don't know, like it's 12.5% tax for most corporate, but when you're doing anything that involves property, it's usually 25%, certainly on their income side. So be interesting to see how that pans out as well. We could also be looking at enhanced capital allowances for developments that meet social housing quotas. And then also something that used to be talked about a lot, but I haven't heard about it in quite some time, is the potential for public-private partnership tax relief. And that would be where private investors receive tax credit for contributing to state housing projects. Now, what is likely to prevent the government from doing some of those things? I mentioned it already, but they're going to be very cautious for the following reasons. One, they want to avoid market overheating, and they want to avoid speculation that drove up house prices and all that kind of stuff. So that you're not going to see, as far as I can imagine, you're not going to see blanket tax relief. The measures are going to be quite narrowly targeted on specific locations and specific sectors. The next thing that we're likely to see is they're concerned about a fall off in the revenue that's being collected. And that is something that in the past there was these big tax giveaways, and there was a lot of tax that fell down. And what that meant was that you had to reduce services in certain other areas. And it also meant that, high national debt rates that we have in this country, it would be hard to justify that politically. Avoiding overdevelopment in the wrong areas. I mentioned already that you've got location-specific and time-limited targeted incentives will hopefully prevent the return of any kind of ghost estate. And so it's going to be the primary focus on brownfield urban infill projects over greenfield sites that are making the city expand further and further. Because every time you go further out of the city, it means more roads, more public transport. Whereas if you're just building in the city centre, then you're already in there, and it's already surrounded by amenities and various things. And then the final thing, the EU state aid and taxation rules. The European Commission is increasingly watching tax incentives in member states. So Ireland may need to design reliefs carefully to avoid conflict with the EU competition rules. And this could mean more direct subsidies or grants rather than tax breaks in some cases. So, final prediction, expect a tightly controlled, time-limited tax relief package focused on brownfield regeneration, small landlords and rental supply. Mistakes of the 2000s will make this government very reluctant to introduce large-scale incentives, and the Department of Finance may resist broad-based tax cuts due to fiscal risks and EU constraints. So we'll all be watching the next budget. And so, guys, I'm going to go back to my vacation. Hopefully this all worked out well and the modern technology is all working as it should. And so, guys, I hope you found this one useful. Looking forward to catching you next week I'm going to be talking about tenacity. And in the meantime, I'm hoping that the Wednesday episode with another interview with one of my guests will be going out. So, guys, look out for that, and I'll speak to you soon. Thank you for tuning in to another episode of Behind the Facade. If you enjoyed the show or found it useful in any way, could I please ask you to take a moment to leave a review over on iTunes or Spotify or wherever you listen to podcasts. There is no algorithm for the podcast, and so the only way we can get other people to find out about it is when it's shared by you. So if you can do that, it'd be great. If you have any questions or topics you'd like me to cover on future episodes, please connect with me via the school community or just send me a message on Instagram or wherever. You'll see the links in the show notes below. You can stay up to date with all of my content and the projects that I'm working on by signing up for my weekly newsletter, and you'll find a link below in the show notes for that too. That's all for now, guys. I'll see you back here same time next week.